My next guest says that recapitalizing Europe's banks will lead to a credit crunch, consolidation in the banking sector and quantitative easing in the region. James Ferguson is head of strategy at Arbuthnot Securities, joins me in the studio now. James, that's quite a scenario that you outlined. Let me start by asking you about the one area, arguably the one area of progress at the EU leaders at this summit over the course of the weekend, which was 108 billion euros in capital for the banks. How would the banks respond to that?
Well, banks in this environment have discovered, or the market's discovered, or judges that they're undercapitalized. And what that means is they haven't got enough capital for their assets, or more particularly their risk assets, like their loans. But a banking system that has too little capital for its risk assets can't shrink loans, because that might generate a loss, which would further erode capital. So they're caught in a bit of a catch-22. Japan's banks were caught in this catch-22 for 5 straight years with a zero loan growth. They just sat there like rabbits in front of their headlights for 94 all the way through to the end of 98. But when you inject capital into that system, when you see that the banks are undercapitalized and you inject capital, the banks now have the finances to fund the contraction of assets, and that's when the credit crunch begins. And we saw that in the US and UK in October 08. We haven't seen it yet in Europe.
So what are you saying, that actually that there's no point in having this blanket recapitalization and just putting a figure on it? Do we need to have some sort of clarity first as to which banks specifically need to boost their balance sheets and how much exposure they have to European sovereign bonds?
No, what I'm saying is the authorities don't understand what they're doing. They don't understand the consequences of what they're doing. They look at the banks and say the banks are undercapitalized, they need more capital, totally agree, and then they inject that capital into the banks. But if you inject capital into banks that are undercapitalized in an environment where you're also going through fiscal austerity, so the state's holding back in terms of stimulus, the banks will impose or force the private sector to run a surplus. In other words, they'll start contracting existing lending. And when you contract existing lending and the private sector's running a surplus and your public sector's running less of a deficit, that's recession, even depression.
So what can the governments then do to prevent banks from responding in a way that means they shrink their assets and stop lending?
Get out your newspapers for the last 3 years in the US and UK. We have lived exactly this situation. We insisted in October 08 that the banks increased their capital at the very same time that the banks' value of the bank's assets was shrinking. That accelerated the process. We had a massive drop in trade finance, which really knocked down global trade into that final part of the year. And since then, in order to neutralize the contraction of broad money, we've had to do QE. Europe will have to do QE too, and in a big way.
James, what are they supposed to do, though? Then what is the alternative to recapitalization? Because so many of the investors that you speak to nowadays are saying, listen, we're staying away from financials altogether. There isn't enough clarity when it comes to their exposure to the European sovereign bond market. We know that US funds have been reducing their dollar exposure to European banks, and on top of that, their share prices are being hit. So what's supposed to happen to restore confidence?
Well, this is a very difficult question. I mean, the analogy I use to people and in my own head to put this, it's the difference between getting fat and getting fit. You know, during the credit bubble, the banks were getting fat. Very good fun to get fat, but at the end of it, you're fat, and that's bad. You've got to go back to the gym. Now, that means you've got to get fit, and getting fit doesn't happen overnight. And the banks haven't got enough money to buy gym membership, and recapitalizing them gives them enough money to buy gym membership. And the thing that they will do with that money is go to the gym. And so we have to expect that the banks will therefore go out and use this recapitalization to fund the urgent and necessary contraction of their risk assets to bring them back in line with where their capital and the environment is. But doing that is very negative for the state of the economy.
So which banks would be most vulnerable in the near-term future?
It does depend a little bit on where the market perceives the risks to be, because the banks are always vulnerable to two things: insolvency and liquidity risk. And if you're running a wholesale funding gap, then obviously the markets can dry up if they perceive that you're insolvent or for any other reason, and then you're vulnerable to that. And you can become very quickly vulnerable to that, like Northern Rock. Insolvency tends to take a longer time. We work through it in a longer way, and hopefully you don't get a bank run, which is what suddenly tips that over. But the banks that have the least capital are the banks in the safest countries, i.e. the Northern European countries. The Southern European countries, banks have more capital, but then again, they're in an environment where we might expect their assets to deteriorate faster. So it's a bit of a toss-up, but there's no really obvious strong area in all of Europe.
How does all this affect the way that you think about investing in banks and financial institutions right now?
Makes me look at America.
Really, why?
If you look at America, well, because they're so much further through the process. You know, the US dollar has been hammered over the last 5 years against the euro because interest differential terms, the policy response in the US has pushed interest rates down and down and down, and QE's exacerbated that. We now get to get that reversed, so the euro now will get very weak compared to the dollar, and there are some US banks which have realized so much in the way of losses now that they must be at the far end of their loss realization program. Citigroup, I think, for example, looks almost impossible to kill, let's put it that way, under any stress test that I can devise for it. It's so far through that process and now has built up so much capital. European banks right at the beginning of that process.
All right, well, thank you very much indeed. Good to get your thoughts, James Ferguson, Head of Strategy at Arbuthnot Securities.